But once again, Maruti will be in focus. Markets are not very happy with the way Suzuki is conducting themselves, and just about everyone on the street is convinced that the interest of Suzuki and the minority shareholders are not aligned. What was the need for Maruti to really take a decision to set up their new manufacturing plant in Gujarat in the new subsidiary at a time when Maruti Suzuki has a cash balance of about 7,500 crore. Let's understand the rationale from the chairman himself, Mr. R.C. Bhargava, who joins us. Mr. Bhargava, good morning and thank you for joining us. Can you please give me the rationale? Because if I look at your balance sheet and if I look at the interest of the minority shareholder, I find very little merit in Suzuki now really trying to set up the plant in Gujarat.
You know, the Gujarat plant is part of the overall scheme of Suzuki to make sure that its Indian operations are as strong and as healthy as possible. Because India and Maruti are now cornerstones in the strategy of Suzuki for the future. And strengthening of Maruti is therefore a priority objective with Suzuki. Now, the way this whole Gujarat project has been structured, especially its financing and the way the cars will be priced for sale by Maruti, it will result in Maruti getting a much higher return on capital, increasing its cash reserves, making bigger profits than what would have been possible if we had invested the money ourselves. And that would obviously lead to strengthening of the company. And the stronger Maruti becomes, the better is the future prospects for Suzuki in India.
Mr. Bhargava, morning. You have a sizable amount of idle cash as well on your balance sheet. Didn't it make sense to invest the same in Gujarat and try to focus on the future when possibly the return ratios could improve?
We have done the calculations. We can share those calculations sometime with you, but the option of doing the projects ourselves with our money and doing it with Suzuki's money when the Suzuki money is actually without cost, in the sense that pricing of the cars made by Suzuki is with no cost of capital. The second option of doing it with Suzuki's money is financially much better for Maruti than doing it with our own money.
So what is the duration of the agreement between you and this Suzuki unit?
The initial contract manufacturing agreement, which is yet to be finalized, will be for a period of 15 years. And it will be renewable after that, with mutual consent of both parties.
Analysts worry, Mr. Bhargava, that your margins and growth potential in terms of exports will be capped with this decision. What's your comment?
No, it would not be. I think the analysts and others have not fully understood what we are doing, because the prices, the margins depend on the cost of production and the price at which the contract manufacturer gives you the product. If the contract manufacturer is giving you products which have a lower price than what you could get by somebody who charged the full cost of capital, then margins cannot get reduced. And since Suzuki is not selling directly to anybody, all sales are through us, all the benefits of a lower priced product come to Maruti, not to anybody else.
But Mr. Bhargava, experts also say that in the future there will be a possible merger or sale of this Gujarat plant back to Maruti Suzuki.
No, Suzuki is 100% owner of the Gujarat plant. Why would they sell it? Because they are keen on building their Indian operations. That's where the future growth of Suzuki lies. So why would they sell that plant and cut their own feet?
So will the margins of products from Gujarat and Manesar plant be different then?
Of course, the margins depend on the product itself and how the market treats those products. All our products which we make don't have the same margins, because those products which are better selling, more in demand, you can have a higher margin. Those products which don't sell, where you have to give discounts, sell at a lower margin. So to compare margins is really not possible. It depends from model to model what the margins you get on those models are. What is important is that the cost of production, the price at which you get the car, that should be as low as possible.
So, Mr. Bhargav, how much money do you think you will make on this lease agreement with the Suzuki's new 100% owned unit?
The land will be released at a rental which will be determined at arm's length. Some independent body will have to determine what is the fair rent for the land. I can't give you the figure today. It has to be determined.
So will royalty cost be incremental in this Gujarat plant?
No, the royalty cost or the royalty rate which Suzuki charges would exactly be the same as if it was a Maruti operated plant. You know, remember Maruti is Suzuki controlled. So how would the royalty change merely because of one plant or the both are Suzuki plants?